Hello guys, it's a beautiful morning out here guys, in today's trade I want to use this opportunity to talk about risk management guys. I want to talk about risk management in this trade. It's not gonna be a long video. I just want to use it to explain something to you guys. How can you be able to trade volatility indexes with your little account of a $50, $100, a $30, and it won't blow it up? Okay, how can you be able to manage that? Okay, is it possible, guys? Can you trade volatility indices with a $20, with a $30, with a $50? Guys, this video is going to tell you the truth and how you can be able to do that correctly, and you won't blow up the account, or you're gonna blow up the account. So these are the two things. These are the two things. Okay, so we're going to stressfully hit the nail on the head. Okay, but before we do that, guys, if you've not subscribed to my channel, guys, subscribe to my channel, click the like button, guys, and share the video. If there are other things you're having difficulties on how to do it, guys, drop it in the comment section. I appreciate it so much. Okay, guys, so we're going to go straight to the question of the day. How can you trade volatility indexes with a small account and grow it? Okay, guys. Okay, so before we do that, guys, the trade that you're seeing on my screen, we're currently milking it. Okay, it was a signal that I dropped. Okay, the signal I dropped it around that should be 9 p.m. Okay, and now is 6 a.m. So we've been following up the markets, okay, till this morning. Okay, so back to business, guys. Now, guys, what you have to understand is that trading is a very risky business. Okay, firstly, you don't have to come into trading with a money that you cannot afford to lose. Okay, that's number one. Okay, now if you have a money you can afford to lose, okay, guys, that is gonna give you a free mind. That's gonna give you also a morale, okay, to trade and hold your trade. So how can you be able to manage your small account? Okay, so this video is strictly for risk management. Okay, guys, so let's assume that you are trading volatility 25. Okay, okay, so from what I said, in assumption that you are trading volatility 25, okay, which is a very good pair. Okay, the volatility of it is a little bit lower to compare to that of volatility 75 and 100 indexes. So let's assume that this is the market you're trading. Okay, guys, so what are you going to do? That you have a $50 account. Okay, so what is expected of you to do? Look at how I do it. You must have analyzed your market. You must have your strategy that you trade. Now, when your strategy occurs, guys, so what you are expected to do is to risk a 2.50 cents dollar from this $50. For me, I'm talking personally. Okay, I'm talking personally. What you're expected to risk is a $2.50. Okay, from the $50. So if you do that, that means you'll be left with four. That's 475. Okay, $47.50. That's what you're going to be left with. If you lose the trade, that's what you're going to be left with. But if you win the trade, depending on your probably your take profit level, will ascertain how much will be added to this very money. Okay, so remember, when you place a trade, if you win, you are returning with both your capital and also your profits. Okay, so if you lose, it's going to be deducted from your capital. So if you risk a $2.50 on this trade, that means if you're entering with a 0.50 loss size, which is the lowest loss size for volatility 25, if you're entering with this, that means you're going to set your stop loss 5 points above your entry. 5 points. You're going to set your stop loss 5 points above your entry. So if I'm entering a trade here, let's assume that I'm going for a sell, then I'm setting a 5 points. So the market is currently at 22.06. So a 10 point from 22.06 should give me 22.16. But because I'm risking a 5 point, so I'll be seeing myself at 22.10. Okay, 22.11. Because I'm going to count 5 points, which is 7, 8, 9, 10, 11. So 1, 2, 3, 4, 5. So if I'm doing that, probably my SL will be somewhere here. That is 22.11. This is it. Okay, so my entry is here. Now, because I'm risking a $2.50, I'm going for 5 points. So if this market moves from here and goes back to this place, my SL will be hit and I will lose $2.50 from my $50 account. Okay, so if it goes to my favor, let's assume that I'll be going for a 1:2. My entry, my SL, $2.50. Then I'm going to for my take profit of $5. So if I'm going for my take profit of $5, 22.05, that means my take profit will be hitting at 21.95. So this is what I will be having. Remember, here is my entry at 22.06. So my take profit should be at 21.96. That will be giving me $5 if the market goes to my favor. So if I'm bringing up a shape, this is what I'm looking at. Now, guys, this is what you have to calculate before you place a trade. This is what you have to calculate before you place a trade. This is what you have to calculate before you place a trade. Okay, look at what you have. This is very simple and clear. So if the market goes for me and push down to this very point, that's I will having $50 plus 5. So I'm up with $5. So my total will be $55. But if the market hits against me, that means I'll be going down on $47.50. 47.50. That is what I'll be left with. So if I also see another setup, I'm going to go again with the same risk to reward ratio. So if I lose, that means on this 57.50, I'm going to remove another 2.50. So if I lose, what I'll be left with should be $45. So upon 2 trade execution, I still have $45 in my capital, which is very, very okay for me. It is very, very good. Now what I've lost after 2 executions is $5. But in a situation whereby instead of you to place a 0.50 loss size for the $50 account, for the $50 account, then you play something like let's assume that you play something like 3.00, or probably you place 0.50 loss size into 6 positions. So into 6 position will be giving you 3.0 loss size. Okay, or let's assume you place it into 2 positions. Into positions will be giving you 2.0 loss size. So remember, on each 0.5 loss size, you are losing $2.50. So let's assume that you have these positions up to in absorption, you have it up to 6. So we're multiplying 2.50 into 6. So 2 into 6 is already giving you $12. Then 6 into 0.50 will be giving you $3. So 12 plus 3 will be giving you $15. So on a single trade that you place with such risk to reward, you'll be losing $15 from your $50. So what you'll be left with here should be $35 on the first trade. Just a single trade that you entered, you lose $15. Remember, we executed two trades then. So execute the next one again, you lose another $15. So what you are left with here should be $20. You are going down. At this very point now, you are now looking at for a way to push back this account to $50 or even up to $40. The pressure of making profit is now coming in. The emotion of entering trade when it is not, there is no setup is coming in. Do you see that? And there is now 100% probability that you lose the remaining fund because you will try to double it, you'll be trying to overshadow it. Now, while when you lose for $45 in the two trade and you win the next trade of $5, you are back to your capital of $50 with ease. But in a situation whereby you lost 35, left with 20, there's a probability that when you are winning, you might not win up to the 35 again to make up the 50 you have. So guys, this is very, very simple. Risk management is very, very simple. Now, for you to be able to understand how this works very, very well, guys, you need to study each pair that you want to trade. Study the pair and know the distance, what dollar value that is it in each price level. Between each price level, what is the dollar value? Like let's assume that here you have 22.06 when you place your trade. Be careful in this, guys. Put your concentration in this. Okay, this is very, very simple. It's very, very important. So between 22.06 and the place you are placing your SL, which is 22.11, can you be able to know the amount of dollar that you will lose on a minimum loss size of that very pair? On a minimum loss size of that very pair, if you place a trade using the minimum loss size of that very volatility pair, from the point you placed your trade to the point you placed your SL, what amount of dollar are you going to lose? From the same point you placed your trade to the point you're expecting to take your profit, what amount of dollar are you expecting to gain if you are gaining? So this is why you need to concentrate on few pairs, study them, understand them, and calculate their price ratio with dollar. Understand their price ratio with dollar. So it is not enough to get a strategy. It is not enough to figure out an opportunity in the market, but understanding the pair price to dollar, the volatility index pair price to dollar is very, very essential. If the market move from here to here, how many dollar am I expected in a 0.50 loss size? Now let me give you a hint before I end up this video. We'll cut it off here. If you are trading volatility 25, at every 10 to the next 10, at every 10, at 2200, at 2200, we are considering 20 as a 10. At 2200 to 2210, going down. Let me delete this so that we can have a clear view of what we're doing. Okay, 2210. We are considering 10. So this is what we have from 2200, from 2200, from 22 from 22 and 20 to 2210. If you're entering with a minimum loss size of 0.50, 50. The dollar amount corresponding to the price of this pair is $5. What do I mean by this? If you place a trade up here, let's assume you place a buy up here at 22.20. If you place a buy at 22.20 up here, you place a buy up here. If the market goes against you and hits this point, you're going to lose $5 on 0.50 loss size, which is the minimum loss size. Do you understand that, guys? I don't know if you understand what I mean. If you place a buy trade at 22.20, you're expecting it to push up. Eventually, the market push down against you, and it push down against you up to 22.10 level. What you're going to lose is $5. If you place a sell trade at 22.20, you assume that the market will sell, and the market sold till 22.10. If you are winning, what you are going to win is $5. So this is very, very simple, guys. This is very, very simple. It's a very, very simple concept. So I just want to use this trade and explain this to you guys, because it's very, very important that you manage your risk to reward very well, because this is a business, it's not a gambling. Okay, so even the professional gamblers calculate their risk to reward, because it's a game of probability. So that is it, guys, for this video. I'm going to end the video here, guys. So see you guys in the next video. Drop your question. I will explain more on how you can be able to calculate your risk to reward in all volatility indices pairs. Okay, guys. So see you guys, including boom and crash. Click the like button if you benefit from this video, guys. Show appreciation, guys. Away.